Hello and welcome to this case study, a 56.7% savings. I am Matt Dakar, your host. I'm so happy you're here to watch this quick video. I think I hope it opens your eyes just a little bit. If you're at this point, then um, you probably are going to see some stuff here that might make you think a little bit. So, without further ado, let's get in. The first thing I want you to understand is that not every insurance company is created equal. Most companies have a special niche they are most competitive in. For example, Nationwide is extremely aggressive with agriculture and farms. A lot of people don't know that. I didn't even know this. Okay, we recently met with Nationwide at our office, and we met with the head of the region. I think he was out of Chicago. I want to say. Don't quote me on that. But we had them in our office, and they talked extensively about agriculture, everything dirt to table. They called it. Actually, five of their nine board members, over half of them corporately, are former farmers. A lot of people don't know this. I didn't know this. I thought this was surprising, but they told us over and over and over again how everything agriculture they want to go after, they want to get it, they want to write it. It's something they want to dominate. So, don't you think that it would inherently mean that if you were to bring a farm policy their way, they would be extremely aggressive not only in the pricing of the insurance, but the renewals and also the future business, um, in the market of agriculture? I mean, it makes sense, right? The Hartford, okay, is another example out of Connecticut, right? You've probably heard of them or even insured with them at some point. You could even be insured with them now, for all I know. They are extremely competitive and aggressive in the workers' compensation market. They've been an industry leader and a number one writer of workers' compensation nationally for years. So, don't you think when it comes to your business's workers' comp, they will be an extremely competitive option for you, or could be? These are just a few examples, but it breaks down even further. Within the companies themselves, even in a preferred market, such as agriculture, or a type of product such as workers' compensation, which we just went over a few brief seconds ago, the pricing and coverage offered for that pricing can vary. So let me break it down a little bit further. We'll call this Company A. Company A has been in business for 20 years. Okay, this is obviously hypothetical, but very very common example. Maybe this is a profile similar to your company. I mean, for all I know. They have an established business, and their annual revenue is estimated at about $1 million. They've had no claims on any of their policies in the last 5 years. This company employs approximately 8 people. Now let's call this example Company B. Company B has 30 years of experience, but annual revenue of only $750,000. They've had one claim in the last 5 years. Let's just assume it was on workers' comp that totaled approximately $12,000. They employ approximately 11 people, two more than Company A. Given this very close scenario, who would you think would get a better rate on their coverage? And that's kind of a trick question because the honest answer is it depends on what it is and what the coverage limits are. The point I'm just trying to make here quickly is that it's not black and white. It takes being in the trenches day in and day out with all of the top 25 companies, now 25 companies that we personally represent and I personally write with, to know which company is best for your business, right? And your unique situation in history. Everybody's different. Everybody's company is a little bit unique. Everybody's situation in their business is different. The claims history, how many years of experience, like all these things can be a little bit different from company to company. So let's get back to the beginning here, right, where I wanted to explain how I recently saved a local client of mine 56.7%. The 56.7% off case study. This client, we'll call them Company Happy. I know it's so just painfully unique, you can't help yourself. The owner came to me. He explained his business is hard to get coverage for general liability insurance. He's a roofing contractor, but mainly does siding. Now, I won't get into too many legal details here, but it is common knowledge, and if it's not for you, it will be now, that New York State is one of the hardest states in the nation for a contractor um, and insurance, basically, due to New York State's very strict labor law liability clause. He had coverage with an excess lines insurance company. if you don't know what excess lines is, basically it's when you can't secure coverage through authorized or also called admitted companies in your state and have to get coverage through a company who is not admitted or authorized in the state you live in. So basically, like um, in New York State here, there's companies like Nationwide, Hartford. Those are what are considered admitted and authorized companies. They register with the state and they file with the state. When all of those companies that are admitted will not write you, then you can go to what's called excess lines, which is, like I said, you can't secure coverage through an authorized company. You can get it through excess lines insurance companies. It's basically still very good companies. They're just not technically filed with the state you live in. And insurance laws are confusing, but just follow me here. The company he had coverage through, though a good company, was charging a rate roughly 60% more for his type of business and work than the company we ended up securing for him. Okay. Both are great companies. Okay. Both financially secure, no problems there, and very, very well respected in the industry and, with other companies. The only difference was company one's rate for roofing was almost double, okay, the rate for company two, the company we ended up using. Double, okay? And the ancillary types of work that they did was rated roughly 35% higher. So the balance ended up being kind of in the middle, ended up being in the middle of right at roughly 56.7%. Like I mentioned, in a decrease in the overall premium for the policy. The key takeaway here too is that in this case, this client's company had, okay, to go through a different channel for insurance coverage. And that particular channel had premiums that varied widely from company to company, right? So hard to get business, hard to get insurance. They had to go through kind of a different channel, like I mentioned, that excess lines channel where they had to work with a company, an insurance company that was not actually filed in New York State, even though they're a great company. Excuse me. This creates a very sticky situation, right? The premiums just vary widely from company to company. They're not filed with the state. They don't have to comply with the state's premium, basically, rating requirements. So more so than usually happens. More so than usually happens, but it's a perfect example, right, of not all things being created equal. So this is not a really common situation, but again, it's a perfect example. Not everything's equal. Now, that's it really. I hope this quick video opened your eyes and got your attention just a little bit. This isn't black and white, and depending on your unique situation, things could be very, very very muddy, and depending on your industry, depending on what you do, you may not think it's this way, but in reality, it very well could be. So what I want you to ask yourself right now is this: when was the last time your broker explained to you why you were with the insurance company you're currently with? If you have a broker, okay, if you have an agent. And having a broker is different than an agent. An agent represents usually the insurance company, whereas a broker represents you, and we shop many, many different companies, which is why I mentioned that earlier. Now, if that has ever happened, right? Have they ever told you why you're with the company you're with? If it hasn't happened, why not? If the reason is simply price, do you know what you're currently being covered for and at what levels? Do you know what is being specifically excluded from your policy? Has your broker actively gone to market with your policies? Excuse me. To make sure you're still in the right place and at the right price. If not, why not? I mean, I recommend doing this at least once every 2 to 3 years, okay? So, what I want to invite you to do now, if any of these things have opened your eyes and curiosity, even just a little bit, is I want you to click the button right below this video and schedule a complimentary discovery call where we can exchange some brief information and you can find out if taking a closer look at any of your insurance programs might be something you want to do. Okay, this is completely complimentary. It's very brief. It's just a really quick call between us to make sure that we're on the same page, just to get some real brief information about the business, and you can decide then. Okay. So thanks for your time, and I invite you to now go ahead and book your call now.